Good morning, my name is James Thorne, co-founder of Tenancy Stream. I'm here today with Simon Murphy, financial advisor, who is going to talk to us about how to get going in the property industry, how to get buying properties, finance options, what's available. Simon, introduce yourself.
Thank you very much, James. As I say, I'm Simon Murphy. I work with Fenton Simpson. We're mortgage advisors. We specialise in mortgage advice. We don't do the general financial advice. We feel as though it's better to actually be a specialist in mortgages. We can help you with a residential mortgage for the house that you live in, or one of my particular specialties, and probably the reason we're talking today, James, is that I love to do the buy-to-let type mortgages as well as some commercial finance.
At the market at the moment, what's available for either a new landlord or current landlords? What finance options are there available to get started, really?
Right. Yeah. I mean, we could. The general rule is if you're looking to do a buy-to-let mortgage, to buy a property with a buy-to-let mortgage, then the starting point is that most lenders will be happy to do that, provided that you've got a 25% deposit, and that the rental income is sufficient by a margin to cover the interest on that loan.
What sort of margin is it? Is it a certain percentage of the rental
value?
Value?
As a general rule, as I say, there are always ways. There are always different lenders doing things slightly differently, and that's where I come in to find a deal and to make it work. But a good starting point is that lenders will look to ensure that your rental income covers your mortgage interest by a factor of 145%.
Okay.
And they are going to make the assumption that interest rates are going to go up, and they call that a stress test rate. And this stress test rate, which is quite difficult to say sometimes, is 5.5%.
Yeah.
So they make an assumption: interest rates go up to 5.5%. Can you still afford to cover the interest with the rent by a margin of 145%? That being said, there are ways of getting the interest rate stress test down, and there are ways of getting it down to the old measure that used to be 125%.
Okay.
And it's finding the different lender that will lend on those different rates, because that can make a very big difference between how much you can borrow.
Yeah.
So I go back to what we said, 75% is the max for a lot of standard lenders.
Okay.
But there are a number of lenders that will lend up to 80%,
Okay.
providing the rent stacks up. And then there are one or two lenders that will also go to 85%.
Oh, wow.
And some people do ask me, are lenders wanting to lend at the moment? And absolutely they are, because one of those lenders has come into the market now at 85%, literally in the last month.
Brilliant.
So, there's still an appetite to lend for the right people. I've just been talking with a client, and they were looking to purchase a property at auction. They had lots of equity within their matrimonial home.
Yeah.
But the particular property that we were looking at wasn't going to be mortgageable, hence why it was in the auction. So what we could do there was we were going to raise the funds against his residential home. Obviously, that one is much more dependent upon the client's personal income.
Mm-hmm.
Nothing at that stage to do with rental income.
Yeah.
But what we do in that scenario was we can raise some money against his home, can purchase the property, spend a bit of money on it, uplift the value on it, and then we can arrange a buy-to-let mortgage so that the funds that were initially borrowed on the residential property are paid off.
Yeah.
And in that way, I mean, he did happen to have I think it was £20,000 or £30,000 available effectively to do the refurbishment. But had he wanted to, we could have borrowed the whole lot against his residential property.
Oh.
So there's certainly that way of going about things. From a lender's perspective, they like you to sort of put a toe in the water. And a toe in the water to me is what I call a standard single let to a family, as it were, buy to let type scenario. Traditional, what we know as a buy to let. So they quite like it if you will do that, as opposed to a house of multiple occupation, HMO, just what it says on the tin. You've got probably more than one tenant in the same property, often referred to as room by room let or something like that, or multi-let.
Each room rented out individually, sharing a communal kitchen.
Lenders are a little bit more reluctant to lend to you for your first property if it's a HMO, as a general rule.
Oh wow, okay.
But then there are lenders that will actually lend to you as a HMO. So, you know, there are always...
So what's the requirements on that, would you say? Is it just down to the lender themselves?
Provided that you are creditworthy, that you have some sort of income, and that elsewhere you're not over-borrowed, then generally speaking, the lender is going to be happy to lend you 75 to 80% on your first purchase as a HMO.
Wow.
Now that is unusual because most lenders do have a requirement. It might only be that you've owned a buy-to-let for 6 months and then you'll be considered to be, in their eyes, an experienced landlord. So you've had some experience. With others, it could be as long as 2 years before you can go to a lender and borrow from them for the HMO.
Wow.
So that's why it's, I mean, I would say this, wouldn't I? But that's why it's useful at least to speak to a broker like myself, because if you go to one lender, you get the impression that them's the rules.
And that's it. There's no other options available to you.
Yeah, everybody's going to be the same.
This is how you do it.
Yeah. And it's absolutely not the case.
You just get nowhere.
Yeah.
Or you'll miss opportunities.
Yeah.
Completely miss opportunities.
I see criteria as a framework to hang a deal on, rather than, if you like, a straitjacket to put every deal in.
Yeah.
And because, as a broker, we've got such a wide variety of lenders, it's finding the little niche within each one that is appropriate for the circumstances, whilst applying some general guidelines rather than rules.
Brilliant.
I think it's absolutely crucial that it is well managed, because it can also be quite time consuming if you haven't got somebody that is professionally managing the HMO. And what I say to anybody that is approaching me for finance is that there's a temptation to think, well, I'll save a bit and I'll manage this first one, or I'll manage that second one. Now, maybe with a single let you'd get away with that, but I'm sure you'll tell me that there's good reasons why they shouldn't do that, and that, with all the regulation. I would say with a HMO, don't even think about it.
No.
You know, get it professionally managed, both from a time, from a liability point of view. It's absolutely crucial that you get your property well managed. And if you're planning on growing a portfolio, start where you mean to begin. You know, do you want to be a landlord, or do you want to be an investor? Most of the people that I talk to want to be an investor and want to leave the professional management of a property to guys like you.
Have it all looked after, taken care of. So let's talk about purchasing a property on a bridging loan basis.
Increasing numbers of lenders out there are happy to lend on a bridge basis. where it's all about the property, the
Okay.
value of the property. They're not too interested on day one about what the rentals is or anything like that. They're even less interested in what the condition of the property is.
Okay.
They will, generally speaking, a bridging lender is going to be able to lend you up to 75% of the purchase price.
Okay. Wow.
What they will generally do, though, is they'll look and see, obviously they charge an interest,
Yeah.
and it's higher than a mortgage rate, but it gets the job done. They'll, generally speaking, they'll take a view on how long they think it will take you to, say, refurb that property or refinance it.
Yeah.
They'll look at that interest, they'll take maybe 6 months to 12 months interest off the amount that they will lend you in the first place. So you don't have to pay the interest as you're going along, and they'll lend you that on day one. That then allows you to refurb it and then possibly refinance it onto a longer term buy-to-let at a much cheaper rate. There are some bridging lenders that will actually lend you some money towards the actual purchase price, but that's a little bit more complicated, and we probably haven't got time to go through it. But if that's something that's of interest,
Speak to Simon. What situation would you use a bridging loan opposed to getting a mortgage?
Often a scenario whereby the property isn't mortgageable, so
Okay.
it's been left in a bit of a state. Non-mortgageable generally means it hasn't got a kitchen, or it hasn't got a bathroom, or there's some structural issue.
Okay.
And you'll need to sort all of those things out before you can remortgage it, or flip it,
Yeah.
sell it.
Yeah.
That might be an option as well. Because it's a slightly more expensive way of raising funds, an alternative is perhaps raising a mortgage against another property that you've got.
I was going to say, what security would you need?
Yeah.
Really, against one?
Often a bridging loan is a standalone loan, so they'll just lend 70 to 75% of what they think that property's worth, and don't take any other security. But if there is some other security available, it might mean, for instance, that they will lend you the extra bit to do the refurbishment, or it might just mean that they'll reduce the interest that they will charge you because there's less risk, they've got more security.
Yeah, brilliant.
Challenge with that is, obviously, there's a little bit more cost involved because you're giving them a charge over 2 properties instead of 1. We've looked at scenarios and financed where a client has ended up with no money left in the property. So
There you go.
they might have to put a little bit down initially, but by the
There
end
you
of
go.
the process it's remortgaged, they've taken all that money out and they can go and use that money that they had as a deposit on another one. And I mean, the return based on the amount they've invested is phenomenal in that scenario.
I mean, you've got a cash flowing asset, I mean, you let Tenancy Stream look after it, and it's fully managed, and you've just got an income coming in each month and you don't need to worry.
I mean, it sounds golden, doesn't it? It's no money left in,
Yeah.
infinite return, and you're not even managing it.
Yeah.
Who wouldn't want some of that?
Brilliant. Thank you.
I'll start with the repayment mortgage because that's the one that most people probably know. Certainly associate that with a mortgage on the property that you live in, whereby you borrow however much you need to purchase the property, and then over a period, 25, it traditionally used to be, but now it's sort of extending out to 35 years, and over that period of time you pay the capital and the interest, such that in 35 years' time you'll owe nothing on that mortgage. That's a capital and interest repayment mortgage. What the lender works out is the monthly repayment remains the same unless there are changes in interest rate, and you're paying, in the early days you're paying mainly interest off, but you're chipping away at the capital, and then as you get further into the term you're actually paying more capital off than you are interest. So that's a repayment mortgage. Contrast that with an interest-only mortgage, where literally, let's say you borrow £150,000 on day one, 25 years later, unless you make some repayments off your own bat, you will still owe £150,000 on the property. The vast majority of buy-to-let mortgages are actually done on interest-only basis. It's whether it's right for the client, and we always have that discussion. A lot will depend upon your strategy. It might be that you're wanting to buy one property. It's going to be a bit of a nest egg for your retirement, and on that basis you might not be needing the income in the early days, so you'll pay a higher monthly payment, but you're actually chipping away at the capital, so that in 20-25 years you might have one property, no mortgage on it, and it's at that point that you start to want your income. So if that's your strategy, a repayment basis might be what you're looking for. If you're looking for income, or you're looking to maximise the capital that you've got, build up new deposits for more properties, then an interest-only mortgage might be the one that you want. And frankly, lenders are happy to lend on a buy-to-let basis on interest-only, because were it to go wrong, and they had to take control of that property, they're not going to be putting you out on the street. Whereas with a repayment mortgage, with a residential mortgage, they much prefer to see that being repaid over time.
Brilliant, thank you.
But the options are to take a variable rate. Now, sometimes you might want to take a variable rate if you're not quite sure what you're going to do with the property in the long term.
Okay.
A variable rate might be a deal where there are no penalties should you change your mind and or sell the property, etc. And I mean, in essence, a variable rate, as the name suggests, is one which the rate can go up and the rate can come down.
Yeah.
Interest rates are very low historically. Where we are at the moment, there's an expectation that interest rates may rise over time. Probably a greater expectation of interest rate rises than it falling. So there is a bit of a finger in the air job with a variable rate. Where will they end up?
Yeah.
Contrast that to a fixed rate, where for an initial period of time, be that 2 years, 3 years, 5 years, sometimes even longer, you can actually agree what the interest rate is going to be on day one, and it stays fixed until the end of that initial term. That gives you certainty, so it doesn't matter what's happening. I mean, Brexit is on the go as we speak at this moment in time. What Brexit we're going to get, we don't know. What impact that will have on interest rates, we don't know. So a lot of clients over the last year, 2 years, and still now are thinking, because of that uncertainty, I'm going to take a fixed rate, which is a great thing to do. 2 years, 3 years, 5 years. There's a couple of reasons why landlords might need to think about a 5-year. One is what I've just talked about, the certainty of having your interest rate fixed for 5 years. Be a little bit higher than the 2-year or a 3-year deal. But the other major consideration is that when a lender comes to assess how much they can lend you, if you have taken the option of a 5-year fixed rate, they might actually be able to lend you a little bit more, just because things are that bit more certain.
Okay.
And it all comes down to that complicated equation between what your rent is and what the interest is going to be.